All right, welcome to this explainer. Listen, if you're in your 20s or 30s and you've got your sights firmly set on hitting that top 1%, well, consider this your ultimate BS-free playbook. Today, we're unpacking a complete finance masterclass built entirely from deep, research-backed insights and real-world realities to help you build lasting wealth. Okay, let's dive into this right away, because I kind of need to start with a tough love wake-up call. Is your bank account actually making you poorer? Most of us are taught from a young age to just save, to put our money in the bank and feel secure. But the harsh reality is, there's a hidden wealth destroyer silently eating away at your hard-earned cash every single day while it just sits there. So here's our roadmap for today. We're going to cover 1. The real cost of inflation, 2. Avoiding middle-class traps, 3. Rules to earn more, 4. Smart investing, and finally, 5. Market mechanics. Kicking things off with Section 1, the real cost of inflation. Unveiling the ninth wonder of the world. Think about the good old samosa, right? Years ago, a samosa cost just 5 rupees. Today, that exact same samosa is going to run you 15 rupees. Now, if you had just kept that original 5 rupee coin tucked safely away in a bank account, it literally couldn't buy today's samosa. That is what real inflation actually looks like on the ground. It's this silent thief continuously draining your money's purchasing power over time. You know, we always hear the officially reported inflation rate, the CPI, is hovering somewhere around 6%. But here's the catch. That official number, it doesn't actually track our biggest, heaviest middle-class expenses. I'm talking about education, healthcare, housing, and gold. Those are the things we actually spend massive amounts of money on, and they are compounding at 8 to 14% every single year. So your real personal inflation rate is much closer to 8 or 10%. Definitely not 6. So, let's break down the shocking math here. Imagine dropping 1 crore into a standard bank savings account, earning, say, a 3.5% interest rate. Well, first off, the government steps in and takes a 30% tax on that interest. Then you subtract that real-world 8% inflation we just talked about. And the result? You're looking at a net loss of 5.55% every single year. You aren't growing your wealth in a basic savings account. You're actively bleeding it. Moving right along to Section 2, avoiding middle-class traps, the fast way to become poor. Look, society has essentially built systemic traps perfectly designed to keep people broke and insecure. Things like playing status games with your old school or college friends, that instantly triggers FOMO and massive lifestyle inflation. Or how about upgrading your vehicles unnecessarily? The average person buys 8 to 10 cars in a lifetime. That's a huge drain on your finances unless you're secretly running a taxi fleet. Then there's funding lavish weddings with debt or getting sucked into high-risk futures and options trading fueled by unemployment and sheer desperation. The absolute best advice I can give you here, cut it out. Stop hanging out with peers who trigger your FOMO. Spend your time with older, successful mentors who've already figured this stuff out, and for sure, stop buying depreciating assets just for societal status. And honestly, nothing destroys your financial status faster than the personal loan trap. It is literally like chaining your own hands and feet. Here's how it happens. Step 1, you want a luxury item or a flashy vacation just to show off online. Step 2, you take out an easy personal loan from some aggressive credit company. Step 3, bam, you're heavily tied down by monthly EMIs. And step 4, because of those payments, you completely lose your ability to invest or take calculated career risks. Shockingly, 50% of personal loans today are taken out by people under 28, a lot of times just to fund a vacation. It's a massive wealth destroyer. Now, what's really interesting about this next concept is Section 3, rules to earn more. Strategy is less important than scale. All right, here is a foundational rule of wealth. You absolutely cannot just save your way to being rich. You have got to increase your earning scale. Think about it. If you invest 8,000 rupees with an absolutely flawless strategy, you might gain 12,000. But if you invest 8 crore, you gain 12 crore. The best investing strategy in the world just isn't going to make you incredibly wealthy if your initial capital is tiny. Increasing your scale, meaning earning more capital to actually invest, is step 1. So how exactly did the top 1% actually earn more? Well, first off, change your job address. Seriously, move to richer cities or countries where the exact same work pays significantly more. Geography heavily dictates income. Next up, niche down. Be the absolute best in one specific domain so you become completely irreplaceable. Also, be an A-player employee, because let's face it, great employees eventually become great business owners. Oh, and marry a spouse with a shared growth mindset. Actually, this is a vastly underrated financial decision. And finally, communicate clearly and just never ever stop aggressively learning. Which brings us to section 4, smart investing, the boring way to get rich. I want you to permanently memorize this concept right here, the rule of 72. It's a brilliant little mental math shortcut that tells you exactly how fast your money is going to double. Check this out. At a 7% return, it takes 10.2 years. At a 10% return, it takes 7.2 years. And at an amazing 15% return, your money doubles in just 4.8 years. Seriously, take a mental screenshot of this so you always know exactly how fast your capital is compounding.
But you gotta beware of the hidden drain of expense ratios. Your friendly broker might strongly recommend an active fund, which charges a seemingly tiny 0.71% fee. But a simple, direct Nifty 50 index fund, that charges just 0.18%. Over 5 years, that tiny percentage difference in an active fund will literally drain lakhs of rupees from your account, and that's regardless of whether the market goes up or down. Keep your fees low, guys, and don't pay unnecessary commissions.
You also absolutely need to avoid the massive danger of trying to time the market with a lump sum investment. Just look at history. In 1989, Japan's stock market peaked, right? Well, 30 years later, buyers from 1989 still hadn't seen a return. In India, the 1992 Harshad Mehta scam crashed the market, and between 1992 and 2000, investors saw 8 straight years of 0% returns. The big lesson here? Absolutely no one can time the market perfectly. This makes a really strong case for consistent monthly SIPs, systematic investment plans, instead of just throwing all your money in on one big bet. Let's move on and see how this all builds together in Section 5, Market Mechanics, Understanding the Big Picture. Now, you're going to hear the term repo rate in financial news all the time. But simply put, it's just the risk-free interest rate set by the Reserve Bank of India to lend money to commercial banks. This rate is basically the master lever used by the central bank to control inflation, and it directly dictates the cost of all your personal loans, your housing loans, and your business loans. So here's the domino effect of how that rate actually plays out in the real world. When the economy is frozen, kind of like it was during COVID, step 1, the RBI steps in and lowers the repo rate. Step 2, bank loans become much cheaper for consumers like you and me. Step 3, because money is cheap, people buy more homes and businesses take out loans to expand. And step 4, the economy heats up and GDP grows. Conversely, when inflation gets way too hot, the central bank just raises the rate to cool everything back down. All of which brings us to the absolute core thesis of this entire explainer. There is a boring way to get rich and a fast way to get poor. Patience, prioritizing true value over current price, and consistent long-term investing will always beat flashy trends, trying to time the market, and taking on toxic lifestyle debt. True wealth, it's built quietly, and it's built steadily. So I'm going to leave you with this final thought. Will you choose the boring, highly disciplined path to the top 1%, or are you going to take the fast track right into the middle-class debt trap? The tools and the knowledge are all right here in front of you. Take immediate ownership of your financial future today, and let's start building some real, lasting wealth.